Good morning, ladies and gentlemen, and welcome to Macro Ace with your host, Tony. And today we've got our headline release for the week as well of the US inflation data. Hopefully, you can all hear me clearly. Hopefully, there are no issues with the sound. If there are any issues with the sound, do let me know and I'll try and fix it as soon as I can. FX Burst says, good afternoon, sound clear. Good, awesome, good to hear. Okay, so we've got our inflation data today. A lot of the markets have been, most of the market has been pricing it in. From what we can see, as expected, inflation data is to head down, or to see a reduction in inflation data for the US today. But let's go through some of the bits just to understand before the release and some of the sentiment as well. So, US CPI. So what is it? So what it measures how much consumers are paying for retail goods and services, and about 26,000 retail outlets and 4,000 housing units in 87 urban areas are measured or are surveyed, and prices collected on 80,000 goods. Okay, so the release itself is very accurate because the way that the survey is done is that they will send out agents, or they'll send out agents to go to retail stores, service areas to see how much the price of goods has changed, and then they'll collate all that data together, and then we get our inflation readings for today. So the key measurements then of the inflation report that we've got to be aware of, and the reason why it's an important release. Scotch and Stock says, let's go. Awesome. So the key measurements then, so we've got to bear in mind, is that housing makes up the majority, or is the biggest part of the CPI report. Then we have food, which represents about 15%, transportation 17%, and medical care, which represents about 7%. Of course, there are other measures too, such as recreational goods and services, and also tobacco as well. But these are the majority or the largest part of the CPI report that we get. So, core CPI then, that excludes food and energy. Of course, that's that's going to be quite inflated, considering how we've had the recent not too long ago, we had the Ukraine-Russia conflict having an impact on prices, and how that's also disrupted supply chains as well for businesses, making it harder maybe to create the goods, provide the services that they need to provide, and also for the products that they create too. If they know that if they know that price of crude or price of energy prices overall are going to be more expensive, then a lot of that may be factored into consumer prices as well. Of course, we have PPI prices, or the producer price index, which would heavily factor in that extra amount of inflation or pressure that we see from the crude market feeding into, or the energy market feeding into the businesses in the US as well. So if we carry on then, so if we're looking at how it affects the market, so in a normal scenario, so usually what happens is the dollar tends to strengthen when the economy is growing and when inflation is seeing a little bit of a pickup. Of course, you have got to bear in mind as well with expectations of the central bank hiking rates, and globally when central banks start to hike rates to try and dampen inflationary pressures, what happens is that when, and what we've recently seen as well, when inflation data has come out much stronger than expected, or much stronger than economists and markets were expecting, then we usually see a rise, or what we've seen is appreciation in the dollar, because of the markets factoring in that, okay, if inflation is much stronger than expected, the central bank may take stronger action to try and rein in or dampen inflation pressures. So hence the dollar usually and currencies of whatever whenever CPI data is released for whichever country, maybe in the UK or the EU, the currency tends to strengthen. So that's what we've seen recently so far. Then for stocks, so the key bits of data then, FX Pair says, do you have a formal degree in economics? Well, we can talk about that, but we've got a lot to get through in this here. So the underlying, actually, my degree was in drama studies. Just to let you know if that was, but markets, and news, and global politics has always been something on my mind. So I am addicted to it. So stocks then. So the key thing for stocks is looking at the core CPI data or underlying inflation. How much inflation is there really in the US economy, excluding food and energy? So if underlying inflation is seen rising sharply within a month, it can lead to stocks taking a hit. And we have seen that with the previous CPI releases as well, or with inflationary releases or indicators that measure inflation, that we've seen that we've seen stocks and the markets take a hit because there is the markets are fearing that central banks will take stronger action. Scotch and Stock says, I have a degree in economics. This guy knows more than me. Okay. Well, thank you very much. I appreciate that. But yes, so with stocks, the key measures then to keep an eye out for is the core inflation data. Is of course bearing in mind you do have the headline figure as well with the CPI month on month. Of that usually traders have put more of an emphasis on. That's the headline in the report as well, and that's what the government uses to see how strong inflation is month on month. Of course, the year-on-year figure as well, of course, is what inflation is. So at the moment, CPI is at inflation is at 8.5%, which again is a 40-year high. So for stocks, again, core CPI data is going to be quite key. The stronger it is, the worse it is for stocks, and the weaker inflation data is, the better it tends to be for the stock indexes. Now for bonds, this is a bit more tricky. The reason being is bonds have an interesting relationship when central banks start hiking rates and when the economy is in expansion mode or when the economy is stalling. So usually a higher inflation reading can lead to high yields in an expansionary environment, as I said earlier on. So what that means, again, is similar to the dollar. We've got to think about it there in the dollar's reaction. When the central banks start hiking interest rates, they're hiking the short-term rates, right? That's where they play ball, let's say, where they control yields, bond yields the most. The longer term yields is left more so to the markets to make up their minds. But if inflation is quite high or much higher than expected and is way above expectations of the Federal Reserve or a central bank, then what that can lead to is, of course, an appreciation in yields in the thought that there could be stronger or bigger rate hikes coming in the future. So for the yield market, for the bond market in regards to yields, we'd potentially see an appreciation in yields, and bond prices would see a move towards the downside. Now, one thing to bear in mind as well, usually once rates reach the Federal Reserve or a central bank's neutral rate, which in this case they're looking at 2.5%, where they'll get the Federal Reserve interest rate too, then that's going to be kind of interesting to see what happens in the markets then, or in the bond market, because rates would have got to where the Federal Reserve wanted it to be. So the expectations then would be, does the Federal Reserve go even further with rate hikes? If they don't, what we could see is a move back to a risk-on sentiment where we see investors going back to the stock market once the Federal Reserve has kind of cooled things down in regards to their tightening. But and again, that could lead instead to yields going lower, right? And bond prices, yields going. What it could lead to is what in a normal scenario could lead to yields going slightly higher, with bond prices kind of staying stable as well. So that's going to be quite interesting to see what the reaction is going to be for the markets when we do get to that level of interest rates, or interest rate level with the 2 to 2.5% as a neutral rate. Okay, if we keep going then. So let's go ahead. So the previous report that we had for CPI, so consumer goods prices, which have been at the heart of this recent surge in the US inflation, are beginning to decrease just as service costs rise. Prices for goods excluding food and energy and used automobiles or used cars climbed 0.4% in March from the previous month, which was the smallest increase in a year. And that price slowdown was caused in part by moderate price increases in clothing, new cars, and housekeeping goods. And the core service prices, excluding energy, rose 0.6% from a month earlier, the most since October 1992, and consistent with the economy's broader reopening from COVID limitations. So overall, the data was quite strong. From what we'd seen. Of course, when we were looking at the previous release, when we were talking about the forecast figures compared to the actual figure, there wasn't too much of a deviation or really big deviation from the forecast figures that we had, and we'll go through the prior release as well. But overall, the CPI data was stronger slightly stronger than expected for the US economy. So let's keep going then. So where is the economy at the moment? So we have non-farm payrolls, where the data came in at 428K versus the prior 431K. The deviation on that wasn't too much. There was probably about 40K deviation from the forecast figure to the actual figure. So the markets were seeing a bit more choppiness come into the markets. But the reason why we're focusing on non-farm payrolls as well in where the economy is at the moment is because the more jobs that are created, the more, of course, consumers and workers can potentially be added to the labor force. And in turn, that can increase the amount of spending that there is within an economy. And of course, that will naturally lead to higher prices for goods and services. So non-farm payrolls, it wasn't weak, or it wasn't too strong. So it could mean that, of course, businesses, for consumers, inflationary pressures could tick down later on in the future. But again, that's yet to be seen. But just again, one key economic indicator to be aware of. The unemployment rate was unchanged at 3.6%. It was forecast to decline to pre-pandemic levels at 3.5%, but that didn't happen. Average earnings year on year slightly lower at 5.5% versus 5.6%. A key metric or key indicator for the Federal Reserve to see that wage inflation isn't spiraling out of control, that there might have been some reprieve, let's say, in wage inflation for the US. Employment cost was at 1.4% for the quarter. PC price index, which is the key measure of inflation for the Federal Reserve, which was at 6.6% versus a prior of 6.3%. And the core PC price index year on year was lower at 5.2% versus a prior of 5.3%. So again, you've got to remember that the core inflation readings includes food and energy, whereas the excludes food and energy. So that this is giving a reading that maybe inflation might be slowing down in the economy already, or there might be some reprieve. The US ISM manufacturing prices paid, what businesses are paying for the goods that they're making. You can see that that had also declined as well at 84.6 versus a prior of 87.1. The February non-farm productivity quarter-on-quarter data was much higher at 1.4% versus a prior of minus 0.2%. So productivity, so non-farm productivity for the quarter, seeing an increase in productivity. Although bearing in mind we did have some really bad data where GDP had went into the negative territory at minus 1.4%, if my memory serves me well. So much worse. It was much worse than expected. Import prices as well is quite key to bear in mind. The more that the US or country imports into its nation, that means that there is more spending that is going on, and that would add to inflationary pressures. So it came in at 2.6% versus a prior 1.4%. Export prices is also quite key too. It came in at 4.5% versus a prior of 3%. So we can see that inflation. So we can see that there were some price pressures in our trade area of the US, and PPI year on year, which has been very high, came in at 11.2% versus a prior of 10%. So the PPI data, although it is something that markets keep an eye out on. Okay, but if we're thinking from an economist's point of view, usually what happens is that if PPI prices or producer price index shows that the prices that the prices of businesses are paying for the goods that are being created is rising, what can happen is that a lot of those price pressures could be passed on to consumers. So what we've seen recently is that although yes, that has been true, that businesses have been paying more to make the goods, and that's something that has been passed on to consumers. But I think we'll yet see what the PPI data does tomorrow, where actually it's also forecasted to see a decline as well in PPI year on year, the month to month, and the core PPI data for month to month and year on year. So again, if the expectation is for inflation to fall, to see a decline for consumers, could that mean that actually overall inflationary pressures for businesses as well are seeing a decline too? But again, that's just something to bear in mind, and it's quite interesting to see. But all these economic indicators that I'm showing you here will show the price or inflationary pressures within the economy. So as we can see, a lot of it, the core data showing a decline in inflationary pressures, or slight decline. So that's something to bear in mind, is that what could today's inflation report be? Could we actually see a decline in inflation data? And could we potentially see a move, or potentially see some appreciation in the US indexes and a decline in the dollar? Again, we'll kind of go through that, what we've seen in the prior release too, and how that reaction could translate to the rest of the market and for the future. So the triggers then for the economic releases, again, if we look at the forecast figures then, so CPI month on month forecasted to come in at 0.2% with a prior of 1.2%. The highest estimate, according to economists, they see 0.5% or 0.3 deviation, and a 0.2 deviation on the low end. So a low estimate of 0% with a high estimate of 0.5. Also bearing in mind, with CPI year on year forecasted to come in 8.1% with a prior of 8.5%. Core CPI year on year also is expected to see a decline as well at 6% versus a prior of 6.5%. The core CPI month on month expected to see a slight uptick, or an uptick by 0.1% at 0.4% versus a prior of 0.3%. So if we look at the rest of the economic indicators, triggers then, so year on year, high estimate expecting a 0.4 deviation of 8.5%, with a low estimate of 7.9%. And then the core month-on-month high estimate at 0.5%, so looking for a 0.1 deviation on that headline figure there, according to economists, and with a low of 0.3%. Okay, and then the core year-on-year expecting high estimate of 6.3% with a low of 5.8%. Okay, so even though the high estimates, even though we do have those high estimates there, more or less looking for data to move, let's see, a move towards the downside, barring the core month-to-month data that we're expecting today. So also one thing that I'd seen from those picked up on Twitter, that according to JP Morgan on CPI, saying that a light number would allow for a pause in selling, and subsequently we'd experience a bit of a bear market rally. So what they mean is that there might be a bit of a reprieve for the markets from all the amount of selling that's going on from the Fed tightening expectations on the hikes that we've had seen. So that, again, just one view that I'd seen that cropped up across Twitter and some of the wires. So sentiment then. So Fed tightening, what I had already mentioned. So we already had the 50 basis point hike on May the 4th. May the 4th be with you, Luke. So we had that happening with the 50 basis point hike, which was as expected. And we had seen an initial, what we had seen was we'd seen an initial appreciation in the dollar, but that didn't last long. And because, as I said, there was nothing surprising from the FOMC, from the statement that we had seen on May the 4th. So no, the shocks were weighing in on sentiment. So we'd seen a reversal of that trend of the dollar seeing an appreciation, and it was quite a quick flash reaction where we'd actually seen a movement towards the downside. And similarly to the S&P 500, vice versa, we'd seen that initial move towards the downside, and then quickly it moved back towards the upside and forgot about. And then again, didn't see any surprises from the release there. So as said, it was the first half point hike since 2000, and half point hike in 22 years. So it added to, again, sentiment is still there of expecting 50 basis point hikes at the upcoming meetings in June and July. And if we also consider what Powell had said as well, that inflation is much too high, is what he said at the last FOMC press conference from what we've seen. So could there be, yes, there's obviously going to be more, there's going to be tightening that is going to continue. How much tightening is there going to be from the Federal Reserve? Okay, also you have the EU reducing reliance on Russian energy. That's had an impact on the oil market more so, where it, of course, what they have said is that they will look to remove that reliance on Russian energy by 6 months. So that's currently one of the bits of sentiment that we're seeing in the markets at the moment. But I think when we do the EIA prep as well, there's going to be the Saudis and with the Aramco cutting prices for other nations for the oil per barrel, oil per barrel for Asia by about $5 or $4.95, for Northwestern Europe by $2.50. So again, so you have Fed tightening that's weighing on sentiment, EU reducing reliance on Russian energy, that's also having a slight impact. And then, of course, China's COVID lockdowns too. That's also having an impact where there is a fear that if China sustains its lockdown, that's going to have effect on energy prices, but also international business and trade as well. If you don't have China exporting a lot of goods, or there are lockdowns in Shanghai or key hubs where in industry is a key for the Chinese economy, then that could also weigh in on sentiment too. That actually is COVID. If there's a COVID fear creeping back in, maybe. But again, that's one thing to just to be aware of, that we have those 3 bits of sentiment. Okay. So Fed voting members, I know we have about 5 minutes left. So May 10th, you had Mester saying that she expects PC inflation will return to roughly 2.5% in 2023. So remember, the Fed's inflation goal is 2%, but Fed's Mester saying that still above in still higher in 2023. Also saying that we are not rolling out a 70 basis point hike indefinitely. So now Powell said that that wasn't on the table. Okay, so but we've seen a couple of the Fed members, including Fed's Bostic, mention it too, that 75 basis point hike is not ruled out completely. A lot of it's going to be to do with how the economy reacts or to the interest rate hikes. So is it enough to rein in inflation, or is it enough to kind of slow down the economy? Not too much, not too much so that there is a recession. Mester also said that there are upward risks to inflation and it won't get to 2% before 2024. So again, could we get stronger tightening from the Fed? Feds Williams says inflation rises, an interest rate that accounts for the rise in inflation is required. Waller, the Fed was not alone in making the wrong call on inflation. Bullard reiterated the Fed should get rates to 3.5% in the coming quarters, of what he wants the Fed to do. I know we've got about 4 minutes. So non-voting members, we had Bostic again, not taking anything off the table. 75 basis point hike is a low probability, but if things turn, that may be needed. Kashkari saying that his estimate for the neutral rate remains at 2%. So more dovish compared to the others. Views, Commerce Bank, this is back on April 12th, with the last inflation data. The 8.5 inflation rate in the US in March could be the peak unless oil prices rise sharply again. A lot of economists are saying that if it's above $100 a barrel, then we could see stronger inflation reads. I'm going to kind of skip this now. I want to see the market reaction. If you've signed up to the mailing list, you would have seen our deviations too. This is what we had here. So the previous market reaction was core inflation was lower than expected, leading to a decline in the Dixie, strengthening the S&P 500 and gold and US 2-year bond prices as well. So this is the last release that we had. Again, so S&P seen 82 ticks towards the upside, and about after 10 minutes, it was up 102 ticks. NQ 460 ticks up and is up 588 ticks after about 10 minutes. Dollar yen seen the biggest decline compared to the other currencies or other than cable, where moving wise, so it's seen negative reaction on the dollar. But if you have signed up to our mailing list, you would also receive that there and be able to have a look at it. Okay, and then let's go to the previous reactions. That was the dollar yen, seeing the move towards the downside, and then this is the 2-year bond price. Again, seeing that appreciation there by about 59 ticks. And the S&P, about 81 ticks towards the upside. And then gold has seen about 62 ticks towards the upside there. Okay. So we've got about less than a minute to go. Well, about a minute or less than a minute to go. Let's get our release on here. I think, as I said, a lot of the markets, if I quickly show you this. So the S&P 500, a lot of it has, I think if it's been priced in, the inflation data is going to be lower than expected. We can see already the Dixie is slightly lower, in the day. Then we might not get too much of a strong market reaction. If it's already being priced in, that inflation is going to be low. But again, if we do get quite a big surprise that we've seen with the expected deviations, that we could see maybe a stronger reaction from the markets. So, okay, 4 seconds. I'm going to shush my mush. Okay, 0.3%, 0.3% higher than the forecast of 0.2%. CPI year on year, 8.3%, 8.3% higher than the forecast of 8.1%. So inflation data better than expected overall. Seeing the dollar yen, things move towards the upside, the S&P towards the downside, gold, seeing that move towards the downside there. What is tick strike doing? Okay. So seeing that initial reaction there. If we're keeping an eye, so core CPI data was also better than expected at 6.2% compared to the forecast, and core CPI month on month was also better than expected at 0.6% compared to the forecast of 0.4%. So as I said, overall inflation compared to the forecast figures much better than overall, although compared to the prior figures not as high. If we're looking at the core CPI year on year and CPI year on year, and also for the CPI month on month. So again, well, let's see what else the markets are doing. Gold still heading down, dollar still heading up. I want to see the bond market, see what that's doing too. Okay. Okay, bond prices are going down as well. All right. So we'll see if we do, or as I said, all right, the data was better than expected overall compared to forecast figures, but more mixed compared to the prior figures. So we'll see what the markets do, but still reacting to that inflationary data in a negative way for the stock market, gold, and bond prices. Let's also keep an eye on GBP/USD. What that's doing, because that was the strongest mover last time. Let's count how many pips we had got on dollar yen, or we'd seen on dollar yen. So overall, including the wick, about 39 or about 40 pips towards the upside there on dollar yen. Let's look at cable. Let's grab that here. Let's see. Okay, so it's seen about 59 pips towards the downside there. S&P. Well, let's see what you're doing. Right. So it was about 163 ticks towards the downside. And gold, let's keep an eye on gold too. So even, whoops. Get rid of that. All right. About 53 ticks towards the downside. And ZT, or 2 year. Probably not looking at much on the initial reaction. Maybe about 10 ticks. Or 25 ticks. 25 ticks towards the downside. Oh, so slightly bigger. So about 24 ticks towards the downside on the 2 year bond price. So the yield then, if we have a look. Okay. So the yield, if I just bring up the chart here on TradingView. So that's what we see at the moment. So the 2 yield, seeing that appreciation there from the data. Jeez, when you kind of zoom out on the chart on the S&P 500, it looks quite ugly, doesn't it? From that data. Dollar CAD, crude oil, WTI. Let's zoom in, see what that did. And maybe I need to move. put it on here actually. So Bitcoin had moved down as well. Okay. Yeah. Crude had also headed lower too. Again, stronger the dollar, the more oil you can buy. Okay. Right. That was the reaction. Then let's measure the other figures. Or the other assets. Just one thing to bear in mind as well. If you, of course, have enjoyed this and have found this prep useful, then what you can do, and as I'd mentioned earlier, is you can sign up to MacroAce, to our mailing list. And what we're doing for you guys is we put out the replay of the market reaction that we had seen, or the YouTube video. We post the links for the other upcoming live streams as well, but also what if you had subscribed to us, you'd also get to see the deviations for the prior release, okay, to see how much certain index assets had moved by, to kind of garner and then to make your own informed decision as to what to expect for the release ahead. So again, that's the deviation chart. In brackets represents the move after 10 minutes of the release, and that's the initial reaction going from the start of the candle to the wick, or the top of the wick of the candle, or the bottom of the wick of the candle. So that, again, that's also provided to our subscribers, to our mailing list. It's something that isn't available to, of course, it's something that's quite useful. I think it's and something that people have been asking for in the previous live streams. Is something that they want to look at, and they found quite interesting. Then, so that's the mailing list there. And of course, Financial Juice, the place where you get the live real-time data for the release. I think the key thing to remember is, with a voice and text-based service, or a Squawk service, investment banks use a Squawk and text-based service to stay ahead of what's happening, not only with releases and economic releases, but also what's going on geopolitically as well. So if I bring up a recent example, so we get von der Leyen. Of course, we've got an oil release coming up this week, or today. So if I bring up our oil releases then, so our oil reaction. So we had a headline that came through to us, and we'd put out on the site as quick as we could. That said, von der Leyen said that we will phase out the Russian supply of crude oil within the next 6 months and refined products by the end of the year. Now, if you were unsure of why the market, or why WTI crude oil had seen an appreciation or had seen a reaction, then Financial Juice is the place to be. Not only will you get the reason or the headline as to why the market would have moved, but also we also do provide our own analysis here, or just historical or charting data here, where we tell you where the headline was and where the reaction had started. So this is basically on the dot at 2:50 a.m. Eastern time on May 4th, where the headline had come out, and that was the reaction. So it's quite instant. So if you want to keep up and stay in the know of what's going on in the markets, what's going on headline wise, what's moving the markets, then Financial Juice is the place to be. So at the moment, we have a 7-day free trial. Now we have two versions of Financial Juice. So there is the light version, or the free version, which has a 10-second delay. There are adverts that are played. The economic release triggers, where you can set your own manual triggers for release, is also delayed. But on the Financial Juice Pro version, that is all stripped. So there are no delays, no adverts, real-time, live voice and text service that you can get with us for 7 days. And also, if you have any questions as to what's going on in the markets, then we also have our news desk here. Okay, so you can ask questions to our analyst on the Squawk. Ask them what's kind of going on in the markets. Maybe you want to know what to expect for the day ahead, and that is also again quite a useful feature for a lot of traders to kind of set themselves up for the day ahead. I think also one thing to mention as well, if you can see this again here, the needs to know market risk. So all these headlines are at the oldest 8 hours old, but currently showing you what you need to know, what's moving the markets at the moment, what are traders focused on for that day. So you can see we've updated it quickly with the inflation data. That was what caused the market movement. If you were thinking, what happened at 8:30? Well, there you go. It's there for you. And again, other bits of headlines as well and data showing you what geopolitically what is important to keep an eye out for as well. So that is Financial Juice, and there is a 7-day free trial, which I've just put the link in for you to have a look at there. Again, have a little play with it. If if it's something that you start to find is useful. FXpert says, is a news desk operated 24/5? Yes, it is. So there will always be an analyst here 24/5. Sometimes I'm here on the weekend too, but because I'm just addicted to news, and I always like to stay up to date with what's going on. But yes, 24/5. We've got some other questions too. So we've got Simon H. Said, what tick strike tickers are you using to monitor the reaction? So yeah, good question. So the S&P 500, we've also got the NQ, the dollar yen, gold, euro dollar. You've got your 2-year bond or 2-year US bond, and the 30-year and your 10-year. Those are the main tickers that I focus on when looking at US releases. Of course, for other different releases from other countries, that will kind of be changed as well. But those are the current tickers that I'm looking at. Now, if you're looking at these tickers at the moment, and we're looking at the market reaction, so tick strike, what is tick strike? So what tick strike is, it lets you listen to order flow, okay, of what's going on in the markets. So if you imagine you're in the trading pits and you've got the guys and gals all around you standing, waiting for the market to open, or maybe there's a big headline that's come out, or maybe there's a big bit of news, maybe with the central bank raising or cutting rates from a central bank. And then you start to hear all the guys and gals shout, buy, 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 sell, 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 sell at this, buy, buy, buy. And then putting up their fingers and, looking like they're having a massive old fit or something, or, an epileptic fit. So that buying and selling that you would hear in the trading pits, and of course in the markets, is translated into tick strike visually and audibly as well. I've got my sound down for it at the moment. But what it will do is, if there is, as we can see here, there's some selling pressure coming in, tick strike will show you if there's a lot of selling or buying going on within that asset that you're focused on, or assets, as I'm currently looking at here, currencies, stocks, bonds, and commodity, and then commodity therefore for gold. So with the other neat thing about the tick strike is that you can change up the level of sensitivity. So if we're putting it on 1, then you'd hear more sounds coming through and more visual, or you would see more of a visual reaction from tick strike here. But if you want to know when the markets are really moving, or when there's a lot of pressure coming in, or buying or selling coming into a certain asset, then you can ramp up that sensitivity to about 15. So again, the more sensitive you have it, the more tick strike is going to pop off for you. and the less sensitive you have it when there is a, let's say, stronger market reaction in the, or stronger moves in the markets, then you'd want to set that at a higher rate. But for ourselves, I keep it at 1. It's quite interesting to see the little moves, dips and moves towards the upside as well for myself. But again, you can use that however way you want to use it. And interesting as well, you can also sign up to a 7-day free trial of that too. Okay, so 7-day free trial of Financial Juice Pro, 7-day free trial of Tick Strike. Okay, that's all there for you to have a little play with as well. Don't forget to also, if you liked this video, do give us a like, share the video, subscribe to our channel as well, and also for our Twitter page, also give us a like on, follow us on Twitter too. I post our links on there for the upcoming releases, usually the day before the release is due to happen. But don't forget to, give us a follow on Twitter too. Help us grow. If you like that, of course, if you've liked the content that I've provided with you today, then definitely, it would be kind of remiss not to kind of support us and, show your love, people. Come on. I'm providing hopefully provided good quality content for you. Although maybe time-wise, maybe I need a bit more time for CPI in the future, considering how much I'd had gone through. Let's go through some of the comments then. So we received quite a few comments in the chat. Just gonna kind of see. Scotch and Stocks was asking, where are people in the chat at? Do they believe that inflation has reached a peak? And they said no, it's not reached a peak in his opinion, but the market selling off lately will help bring inflation down. We'll see the effects now or later is the question, and by how much of that at all. Hi. Well, okay, it's a bit late now for me to look at it, but your question was, what will happen if CPI was lower than forecast? Okay, I think that if that would have been, obviously we would have seen more of, obviously we might have seen, as Emery Aksud said, could have seen a small move or small amount of, or could have seen some form of appreciation on the stock indexes and a depreciation on the dollar. Let's also have a look further. Still in the bear market. Oh, there's a lot to go through here. Let's see. And I think that is it. So Poku MHD says the problem is where it's getting blamed on supply issues, commodities. But the truth is it was prone to high levels since the easing of policy by the Fed in 2019. Well, they had reduced rates before we had the COVID pandemic anyway. We were at 1.75% from, I think, about 2.5% in 2019. So before the COVID pandemic, we were already, the Fed was already cutting rates. But then I guess, but then of course the COVID pandemic had exacerbated those effects within the economy. So there was a stronger reaction from the Fed to cut rates back in, or cut by 50 basis points March 3rd, and then by 100 basis points March 15th on a Sunday in an emergency meeting. Or both of those were emergency meetings. One of them happened during the trading week, and then one, of course, on the Sunday. There was the emergency cut there. But also, one of the things for what we're going to be doing as well, if you're interested in understanding how risk on risk off works, and also how to understand economic releases, we'll be doing a webinar fairly soon explaining risk on risk off in the markets. What does that mean? How have different events or financial crises affected or impacted the markets, and what are the key currencies or assets that are regarded as safe havens to be aware of, and also how to kind of prepare yourself in a way for any sort of future market reactions. So we'll be doing a webinar soon on that later on. Maybe again, date is not set for that. Mateen Suleiman says, "Do you think the Fed will stay course, or has the bond market done a significant amount of tightening?" So I think for one of the things that the Fed speakers or Fed members have said is they don't want to try not to focus too much on the markets, and they're more looking to the economic indicators of how well the economy is doing. So again, the key thing for them is, if the economy is still overheating, or if inflation is still stronger than if inflation does continue to tick up, whereas in this case we've seen a tick down in inflation. That's the key thing to bear in mind. Remember, the long-term bond market, or the long-term bonds, right? That's not the area that the Federal Reserve has a significant amount of impact in, right? Or control in, or direct control. That's more left to the traders. So the traders, they might be pricing in, they might be, you might be seeing high yields or higher rate of yields in the markets. But that doesn't necessarily mean that the Federal Reserve is going to take action, because the bond market is seeing a strong reaction or an appreciation in the yields. Okay, so I think one thing to also consider as well, if you're considering, how some people look at the 2-year yield and the 10-year yield as a recessionary indicator, one thing we've got to consider is that you've had Fed's Daily who said that isn't really the best way to measure whether there is a recession, but the best way to measure whether or not, if the bond market is, or if the economy is headed towards a downturn, is looking at the short-term bonds, such as the 3-month bill, and looking at the 30-year bond, right? So again, short-term bonds, or short-term bond market, is where the Federal Reserve has the most impact when they start raising rates or cutting rates. And that's what that's what the Fed's Daily and other economists have said to kind of keep a focus on as well. So we've already had a 2-year, 10-year yield see a slight inversion here and there, not too often. But at that point, the 3-month bill compared to the 30-year bond didn't see an inversion. You'd seen a big old, there's a big old difference or in yield or the rate compared to the 3-month and the 30-year. So again, is the Fed going to focus on what the long-term bond market is doing so much, or the bond market is doing? To a degree, yes, if they're looking at what yields are doing. But if the 3-month is still lower than the 30-year, then I don't think they're going to take that too much into consideration when they're looking at economic indicators of how the economy is doing. Actually, that's quite interesting. What I want to say is that you had Fed's Waller a couple of days ago, who was an idiot sandwich, let's say, what the Fed had in their reaction. He said that if we had known what we had known back then, we would have reacted sooner. So that was, I think, it didn't affect the markets, but I think just for hilarity, more so comical sense, it was quite funny for Fed's Waller to mention that when inflation had got out of control before then. Somebody interestingly said on Twitter, I don't believe so, but somebody said on Twitter, Twitter is always fun. It always comes up with interesting comments and thoughts, that Biden was cautious or wasn't sure of the impacts, or didn't want the Fed to tighten in fear of losing fear of being seen as the bad president in the US. But I don't believe that. That's just an opinion. I try and stay clear from opinions, but I thought it's just something to share. It's just something interesting that I'd seen. Okay, so ladies and gentlemen, thank you very much for joining me. As said, I hope you found the content useful. Did anyone trade the release, or I guess you're looking at what the markets are doing now to kind of maybe see what the direction is? Actually, or if you didn't, then finally, if you just wanted to listen to my voice, somebody said my voice is like ASMR. All right. It is what it is. Okay, so I will see you at Mateen Suleiman said he shorted the NAS a little bit. Had shorts ready yesterday. Poku MHD. Mateen said he's in and out as well. Okay, so let me for the EIA release, I think of course whilst I have you here with me, what I'll do is I'll put it out. I'll put in the link for you to be able to watch the EIA inventories release. We can just get it here. Okay. Whoops. There it is. All right, so that's the link for the EIA inventories. You can have a look and watch us do the preparation there. Again, there's going to be a lot of sentiment and a lot to cover, and I'll try and be quicker this time. FX Spur says, why didn't you work for the feds? Hashtag Tony for president. Well, I don't think I don't want to lose. I don't want to add any more gray hairs. Let's put it that way. I don't want the stress that comes with it. Okay, now I'm getting hashtags Tony for president. Tonynomics. Awesome. All right. Thank you very much, ladies and gentlemen. I will see you later on. All right. Goodbye.